Good day, everyone. Welcome to the second part of the video recording discussion for Chapter 13, and this is Capital Investment Decision. So, for this part, we will be discussing the different tools or techniques used in evaluating different capital investment proposals. And these techniques or tools are categorized into two. One is those who do not use the discounted cash flow or normally called unadjusted approach or does not consider the time value of money, while the other one is the discounted cash flow or the one who uses or considers the time value of money, and therefore it is called time adjusted approach. Okay, so for the non-discounted cash flow, we normally use payback period, accounting rate of return, and the payback reciprocal. And for the discounted cash flow approach, the net present value, discounted rate of return or internal rate of return, profitability index, and discounted payback period will be used. Each technique is or may be used exclusively for one project, or you can use it as in combination to evaluate certain project proposals. So let us start first with payback period. The purpose of this is to determine or measure the length of time required to recover the amount of initial investment. Or it is also called as payoff period or payout period. I'd like to mention that what we have learned in the part 1 of the video recording discussion on the computation of the initial investment, the annual cash flow, and the minimum rate of return is very important in this part because we will not be computing it anymore. Most of the problem will provide the uh, amount for each of the elements of capital investment. But there may be some problems that you will be required to compute for the initial investment, for the annual cash flow, or for the minimum rate of return. Okay, so for the payback period, the formula is net investment over annual cash return. So as you can see, the formula for the payback period requires the computation of the net investment that we have learned in the part 1 of the recording and the annual cash return. After computing or dividing net investment from the annual cash return, the decision rule is if the payback period is less than or equal to the maximum allowable payback period, then we can accept the project. If the payback period is greater than the maximum allowable payback period, then we should reject the project. So the concept is the lower the payback period than as compared to the allowable payback period, the better, because it simply connotes a faster recovery of your initial investment. Okay, so for example, we have here two capital investment proposal. Uh, the initial investment for project A or proposal A is 150,000, and the initial investment cost for proposal B is 300,000. So, hindi na po kayo pinag-compute. The net investment is already given, and that is 150 and 300,000. For the annual cash return for years 1 to 3. For proposal A, they will be receiving 75,000, and for proposal B, 75,000 as well. For years 4 to 5, you will not receive anything from proposal A. However, in proposal B, you will be receiving a total of 100,000. That is for every year, 100,000 every year. The salvage value of the equipment at the end of its useful life is 15,000, both for proposal A and proposal B. The economic life of proposal A is only 3 years, and for proposal B, it's 5 years. So we will be comparing the two proposal, and we will be computing for the payback period and determine which proposal has the fastest recovery of the initial investment. So for proposal A, we simply divide the annual cash inflow or the annual cash return from the initial investment of 150,000, and therefore we will get 2 years. So after 2 years, we can now recover the entire initial investment of 150,000. For proposal B, since the initial investment is 300,000 and the cash return for a year for the first 3 years is 75,000. So we multiply it by 3, we will get 225,000. So after 3 years, we haven't recovered yet our initial investment because that is still 225,000. So we are still lacking of 75,000. Now on the fourth year, the cash return or the cash inflow is 100,000. Since we are only recovering for the 75,000 lacking from the past 3 years, we can get the ratio of the 75,000 over the 100,000, and that is 75.75% or 0.75 of the year. So therefore, the total payback period for proposal B is 3 years and 75% of a year. So you simply, if you wanted to be exact on the numbers of months, you simply multiply 75% from 12 months and you will get 9 months. So that is equivalent to 3 years and 9 months. So choosing between the two, applying our decision rule, if the maximum allowable payback period is only 2 years, then proposal A is very much acceptable. If the allowable payback period is 3 years, still proposal A is acceptable, and proposal B cannot be accepted because it is still more than 3 years, 3 years and 9 months. However, if the payback period allowed by the management is 4 years, then we can accept both proposal. And in cases that we can only choose one proposal, we will choose the fastest payback period, and that is proposal A. Next is a modification of a payback period. This one still do not consider the time value of money, but considers the salvage value as part of the cash inflow or the estimated cash inflow for every year. This is reached when the cumulative cash earnings plus the salvage value at the end of the particular year equals the original investment. So for bailout payback period, the assumption is At the end of each year, we will be selling out or disposing our asset, and uh, we will add the salvage value to the cash returns, so net cash returns for that particular year, to determine whether we could recover all our net initial investment. So, for example, we have here a investment proposal of 150,000, and it's expected to produce annual cash earnings of 50,000 for 5 years. Its estimated salvage value is 70,000 during the first year, and this is expected to decrease by 15,000 annually. Okay. Um, During your basic accounting, you were taught that the salvage value is a fixed amount which is estimated to be the value at the end of its useful life. However, in this illustration, the salvage value is, varies between years. As the years pass by, it gradually decreases to reach its final salvage value. So, this is not uh, in contradiction of what they have taught you or what we have learned in the basic, but actually a confirmation that as we use our equipment, the value of that equipment gradually decreases as we use it or as time passes by. So during the first year of its use, we still have a higher salvage value, and as time passes by, this salvage value also decreases in proportion to the numbers of years uh, estimated to be its useful life. Okay, so for the first year, we have an annual cash earnings of or annual cash return of 50,000, and the salvage value of the equipment is 70,000. Should we decided to stop the operation and recover or all the possible cash inflow, and that would be the annual cash return and the salvage value, that is only equivalent to 120,000. Okay, 120,000. So at this point, we haven't recovered all our initial investment of 150,000. So we cannot count uh, the first, we cannot conclude that we can recover our initial investment for 1 year only, because after a year, it's not yet enough to recover the entire 150,000. So moving to the second year, we will be receiving another 50,000 as cash return or cash inflow. However, the salvage value has decreased by 15,000, and therefore uh, the remaining amount is only 55,000. Should we decided to stop during the second year, the total cumulative cash inflow is 50,000 from the first year, another 50,000 for the second year, and the possible salvage value of 55,000. And that is equivalent to 155,000. So at this point, we were able to recover the entire 150,000, and we are actually in excess of 5,000. So to get or to compute for the total bailout payback period, we will count one already as year one has already passed, and that will be counted as one of the period in the payback period. And to compute for the ratio or the proportion of the remaining amount that needs to be recovered from the initial investment, I want you to take note of this computation. You first deduct the cash inflow from first year, and that is 50,000 from the initial investment of 150,000. That will give us 100,000 to be recovered for the second year. Now, we will first deduct the salvage value to the 100 to the remaining 100,000 initial investment that needs to be recovered, and not the annual cash return of 50,000. Okay, let me repeat that one. We first deduct the 50,000 from the first year, the annual cash return from the first year, and therefore we will arrive at a remaining balance of 100,000 to be recovered for the second year. From the 100,000, we will deduct first the salvage value of the second year, and that is 55,000, and not the 50,000 cash inflow from the second year. Okay, so 100,000 minus 55,000, we still have to recover 45,000. And that is what we will be using as a numerator to the annual cash return for the second year, and that is 45,000 divided by 50,000. We will get 90% or zero point 0.9, and therefore the payback bailout period is 1.9. You will have a different answer if you will divide uh, 50,000 from the salvage value of 55,000. And that is the incorrect way of computing for the bailout payback period. So the correct answer is 1.9 years. So if you wanted to make it more specific, you get the 90% of the 12 months, and you will get the exact numbers of months. Okay, next is accounting rate of return, another tools or techniques used in evaluating a project that do not consider time value of money. Also known as a simple rate of return, or ARR, accounting rate of return, or book value rate of return. It measures the profitability from the conventional accounting standpoint by relating the required investment to the future annual net income. So therefore, the formula is the average annual net income divided by the initial investment or average investment. If you will analyze it carefully, it, it is actually or simply the rate of return, or simply the return on the investment, return on investment, or ROI. They simply call it accounting rate of return because the computation of ARR is, use the net income as computed using the concept or the generally accepted procedure in accounting. Okay, if a cost reduction project is involved, we have a different way of computing for accounting rate of return, and that is cost savings minus the depreciation on new equipment over the initial investment or the average investment. So, as previously uh, discussed during the discussion on the cash inflow or cash return, aside from the cash inflow, we can also consider cost saving as an inflow that can be, that should be considered in computing for the annual cash return. Okay, and also kindly note that the denominator could either be initial investment or average investment. The decision rule for ARR is if ARR is greater than or equal to the required rate of return, then we have to accept the project. If ARR is less than the required rate of return, then we have to reject the proposal. And what is the required rate of return? What we have learned in the previous discussion, the minimum rate of return is also the required rate of return. So we are looking for an ARR that is higher than the required rate of return. So we have here an illustration which is also available on your reference. Consider the following information about a project proposal. The initial investment required is 65,000. The estimated life of the investment, if this is an asset or a machinery, is 20 years. The annual cash inflow is 10,000 per year. The salvage value at the end of the 20-year useful life of the asset is 0, and it uses the straight line method of depreciation uh, for purposes of computing the net income. Okay, so let's compute for the ARR using initial investment as our denominator, and that is an annual cash inflow of 10,000 minus the depreciation for a particular year, and that is 3,250. How did we get 3,250? You simply divide 65,000 over 20 years. And that will give us 10.38% accounting rate of return. For the average investment, that's 10,000 minus 3,250 over the average investment of 65,000 plus 0 over 2. So whenever you are given a problem and ask for an ARR using the average investment, you simply divide the initial investment by 2, unless there is an information that the ending investment or the ending balance of the investment is given. Should there be any changes within the year, then the beginning balance of the initial investment is different from the ending balance of the investment. And therefore, ARR using an average investment is 20.8%. Okay, so I'd like you to also take note that uh, in our previous discussion or in the video recording part 1, whenever we compute for the annual cash inflow, we need to uh, consider the tax effect on the depreciation uh, to arrive at the total annual cash inflow. However, in this problem, we did not consider the tax effect. We assume that this is already net of tax, although I also agree that 3,250 is not yet net of tax. Should there be an information about the tax rate, then you have to consider the tax effect on the depreciation. Okay, so in this illustration, if the minimum rate of return of the company is, say, 10%, and the computed ARR is 10.38 using the initial investment, then we can accept the project because ARR is greater than the minimum rate of return of 10%. However, if the minimum rate of return is 15%, uh, using the initial investment as our denominator will give us a decision to reject the proposal because the computed ARR is less than the minimum rate of return. However, if we will be using the average investment, we will get 20.8%, which is higher than the minimum rate of return of 15%. So, uh, in cases like this, the problem will not give you uh, two different denominator, either initial or average investment. It will explicitly tell you to use either initial or average investment. So if the problem tells you to use average investment, then we can accept the project since 20.8 is greater than the minimum rate of return of 15%. Next is the net present value. We will now be considering the time value of money, and the first uh, techniques or tools used in evaluating proposal, a capital investment proposal, is the net present value. This is the excess of the present value of the cash inflows generated by the project over the amount of the initial investment. The formula is to compute for the present value of cash inflows using the minimum desired discount rate as our rate to look for the present value factor, and then we deduct it by the present value of the initial investment at year zero. Since year zero, the present value of the investment is actually its total cost of investment at that period. So the difference is called net present value. If our NPV is greater than or equal to zero, then we accept the project. If NPV is less than zero, then we need to reject the problem, the proposal. Uh, Based on its formula, you can derive its concept by uh, looking at the components, and that is simply deducting the cost of the investment from the cash inflow. So if cash inflow is higher than the investment, and that means more cash inflow than the investment, then we will get a positive NPV, and therefore we will accept that proposal. However, if the cash inflow is less than the investment, then we don't have a choice but to reject the proposal because it will not generate a cash inflow that is equivalent at least to the investment, the initial investment. So we have here the illustration using NPV for even cash inflow, meaning the cash inflow for every year is the same or similar for each year. ABC wants to invest in a machine costing 80,000 with a useful life of 6 years without salvage value. The machine will be depreciated using the straight line method, and is expected to produce annual cash inflow from operation net of tax is of 22,000. Okay, the present value of an ordinary annuity of 1 peso for a 6 period at 10% is 0.564. Assuming that ABC wants a minimum rate of return of 10%, what is the net present value of this proposed investment And is the proposal acceptable? Okay. First, you need to understand what is a present value of an ordinary annuity and its difference to the present value of one. Okay, we use the present value factor of ordinary annuity when we are computing for the present value of an amount that is to be received every year for uh, a period, and in this case, for 6 periods. So, in short, we are trying to pull back the future cash inflow today or in the 0 years uh, using the present value factor of ordinary annuity because we will be receiving the 22,000 yearly. However, if the problem says we will receive the 22,000 at the end of the 6th year, we will not be using the ordinary annuity. Instead, we will be using present value of 1 and not ordinary annuity. Okay, I hope that is clear. Uh, the problem did not ask you to compute for the present value factor. They already gave it to us, and that is 0.564. In cases the present value factor is not given, you may use the table of present value factor for ordinary annuity, or uh, you may compute it using your calculator. Okay, so we will be using 0.564 as the present value factor. The present value of the annual cash inflow for 6 period is 95,810, and that is 22,000 times, hold on, there's something wrong with the slide, oops. Okay, uh, I fixed the givens or the data in the slides and added the missing statement, and that is the present value of 1 for 6 period at 10%. So instead of using the 0.564, which is present value of 1, we need to use the 4.355 present value factor because this one is the present value factor for ordinary annuity. Again, we only use ordinary annuity whenever the given is whenever the value is to be received every year. But if it is to be received at the end or one-time payment or one-time receipt, then we cannot use the ordinary annuity but the present value of 1 for 6 period. Okay, so since the cash inflow is to be received annually for 6 period, we will use 4.355, and that is 95,810 less the present value of the net investment, which is 80,000. We did not multiply it to any present value factor, or even if you will multiply it, the present value of 1 at 0 years is the same as its value or its initial value of 80,000 because that is equivalent to 1 also. So, deducting the 2, we will arrive at 15,810, and that is a positive value, and therefore we can accept the project because there is a difference of 15,810. We have a higher amount of value to be received for 6 years as compared to the present value as compared to the initial investment of 80,000. Okay, now what if the cash inflow of the project is uneven or is not the same every year? Uh, this illustration is also available on your reference. Let me read the problem first. That corporation plans to invest in a 4-year project that will cost 750,000. That's cost of capital is 8%. The cost of capital and the minimum rate of return is also the same. Additional information, the project is as follows. For year 1, the expected cash inflow is 200,000. For year 2 is 220,000. For year 3 is 240. And year 4 is 260. So as you can see, there is an uneven cash inflow every year, and therefore we cannot use the ordinary annuity, but we need to use the present value of 1 because simply because the annual cash inflow are not uniform or similar to each year. So we use first the present value of 1 at 8% for year 1, that is 0.926. For year 2 is 0.857. For year 3, 0.794. Year 4 is 0.735. You simply multiply the present value factor to the cash inflow and then sum it up to arrive at 755,400. So comparing it with the present value of the net investment of 750,000, we still have an excess of net present value of 5,400. So therefore, we can still accept the project because there is more than amount to be received for the entire 4 years as compared to the net investment. Next is the internal rate of return, or they call it discounted rate of return or time adjusted rate of return. The rate which equates the present value of the future cash inflow with the cost of the investment which produces them. It is almost the same with accounting rate of return. However, for this one, we will be computing for the percentage that will give us uh, an amount that is an annual cash inflow that is equivalent to the investment. The decision rule is if IRR is greater than or equal to the required rate of return, then we can simply accept the project. If IRR is less than the required rate of return, then we simply reject the proposal. Almost the same with ARR. Uh, it's just that in ARR, we did not consider the time value of money. For this one, we will be considering the time value of money, or we will simply get the present value of the annual cash inflow. Okay. Now we also have two situations here, just like in the net present value. We might have uneven and even cash inflows. So let's start with even cash inflow. Assuming an investment of 50,000 will yield an annual cash return of 7,500 a year for a period of 10 years. What is the discounted rate of return, or simply the internal rate of return? So before I show you the table, the first step is to compute for the estimated present value factor uh, by simply using an algebraic method that equates investment or net investment with the annual cash return. So again, our objective is to determine the rate of return, or the percentage that we will be multiplying to the annual cash return that will equate to the total net investment. So since the net investment is 50,000 and the annual cash inflow is 7,500, we are looking for a rate that when multiplied to 7,500 will be equivalent to 50,000. And using algebra, combining similar term and transferring x to the left side, we will get 6.667. Now the step 2 is to look for the present value of 1 received annually for 10 years, or in short, the ordinary annuity for 10 years. The column that gives the nearest value to 6.67 is column for 8%. And the step 2 is actually pertaining to the present value of ordinary annuity uh, table. So this might not be too clear to you, but I think this one is also available at the end of your reference. You will be looking for the value of 6.667 on the 10 year row. On the first column shows you the numbers of years. So you look for year 10, and that will be the row where you will be looking for the 6.667, the nearest value for 6.667. And you will arrive at column 8%, and that is 6.710. Okay, that's the nearest to 6.667. The following column is 9%. You will get 6.418, and that is below 6.667. Okay, so after locating the nearest column that uh, that is above our computed present value factor, and locating the nearest or the lower uh, column, or the lower present value factor that provides uh, as compared to 6.667, that is 9%. We will now be using interpolation to compute for the exact percentage or the required rate of return. And that is by deducting first the present value factor under 8% to 6.667, and you will get 0.043, and then get the difference between 6.710 and 6.418. You will get 0.292. So our present value factor is actually in between 8% and 9%. So to get the ratio between 8% and to what we are looking for, you simply divide 0.043 to 0.292, and it will give you 0.15. So that is the ratio from 8% up to what we are looking for, but not up to 9%. Okay? So the remaining percentage is actually 85% from what we are looking for to 9%, because this one is 15%, and therefore the remaining is 85%. Okay, so if this is 8%, we simply add that 0.15 to 8%, and we will arrive at 8.15% as our internal rate of return. If you wanted to use 9%, which is below the computed present value factor of 6.667, you simply deduct, and that is 9% minus 8.85. You will still arrive at 8.15%. Okay. Next is what if our cash inflow is again uneven? So an investment amounting to 100,000 is expected to yield the following cash return. For year 1, that is 40,000. Year 2 is 50,000. Year 3 is 60,000. So for this one, since this is uneven, we cannot simply uh, uh, copy one of the values from year 1 to year 3, but we need to get its average. So you sum up all the cash inflow, that's 40 plus 50 and 60, divide by the numbers of years to be uh, expected to be received, and that is 3 years, you will arrive at an average cash return of 50,000. For step 2, you do it again, the algebraic method of looking for the value of x or the present value factor. So for this one, that is equivalent to 2. And then you look for the present value of 1 received annually for 3 years. And the columns that gives the nearest value to 2 is the column for 22%. Okay, and then we do again the interpolation. So the difference from 22% to what we are looking for is 0.04223, and the difference from 22% to 24% is 0.06094. We then get the ratio, and that is equivalent to 0.69. And then we simply add it to the 22% to arrive at 22.69%. Uh, okay, but of course that is actually not what should we be doing, because that is what should we do if it is even cash inflow. But since this one is uneven cash inflow, we cannot get or simply use the percentage directly, but we need to convert first the we need to compute first for the total amount using the present value of 1, and therefore the proper computation of interpolation should be uh, like this. You compute first for the total amount for the first to third year using the trial of 22%, since according to our table, the nearest percentage to 2, or the present value factor of 2 is 22%, then we use that as a trial of 22%. Now, if you can observe in the table, the lower the percentage, uh, the higher the possible amount uh, to be computed, because the present value factor is also increasing. So the next lowest percentage is 20%. So therefore, we will be using 20% uh, as a trial percentage as well. So using 0.20, you will arrive at 102,760. Okay, so simply follow the present value factor on each year under 22% and under 20%. And then compare the uh, computed total present value of cash return to our initial investment of 100,000. Okay, why did we comparing it to the initial investment? The purpose or the objective is to get the amount that will equate to the initial investment. So therefore, we use the initial investment. and the difference is only 540. And then to get the ratio from 22% to less than to more than 20%, we simply get the difference between the total amount computed under 22% and 20%, and that is 3,300. The difference between 99,460 and 102,760. Then you divide to get the ratio. Since the difference between 22% and 20% is 2%, so you need to multiply it as well to the 2% difference. And then you can now deduct this 2%, the ratio in the 2% to 22%, or in short, that's 21.70%. If you will start from 20%, you will just have to reverse the operation. That is 20% plus 1.70%. And that is the remaining ratio from the 2%. Okay. Next is the payback reciprocal. Although this one did not use uh, the discounted, I mean the present value factor. Uh, the purpose of computing for the payback reciprocal is to estimate the rate of recovery of investment during the payback period. Remember that payback is a measure of how fast we could recover our investment, and that is in terms of numbers of years. For payback reciprocal, we are trying to compute for the rate of recovery within that payback period. And therefore, the formula for this one is the annual cash inflow over the net investment, or simply 1 divided by the payback period that we were able to compute previously. Next is the profitability index. This one also considers the uh, present value of the discounted value of money, the time value of money. Okay, also known as present value index, benefit cost rate, desirability index. This is the ratio of the total present value of future cash inflow to the initial investment, used as a measure of ranking projects in a descending order of desirability. The formula is to divide present value of cash inflow over present value of net investment. Actually, you should, I mean, to simply remember the formula for profitability index, it is almost the same with net present value. However, in net present value, you deduct present value of net investment. But for profitability index, you divide present value of net investment to the present value of cash inflows. So the decision rule is if present value index is greater than or equal to 1, we accept the project. If it is less than 1, then we reject the project. Again, the purpose of this one is for ranking purposes. Which alternative or which proposal should we be accepting first over the other? Okay, so we have here three proposals, A, B, and C. The present value of cash inflows uh, for each proposal are given 244 for A, 130 for B, and 130 for C for simple illustration purposes. Uh, We did not compute anymore for its uh, original value, and you were given already the present value of an annual cash inflow. Less the investment required, that's 200,000, 100, 100. You have a net present value of 44, 30, and 30. So using the net present value, it seems like all of the proposals are positive and therefore acceptable. We have positive 44, positive 30, and positive 30,000. Now the objective now is to determine which one should we accepting first, and therefore we can now use the profitability index. Since the company has a limited funds for investment, and that is equivalent to 200,000, we are being asked to which uh, investment proposal should we invest our available funds. Okay, so let's compute for the profitability index of A, B, and C, and that is 1.22, 1.3, and 1.3. So the highest, the higher the profitability index, the better the proposal. So in this case, B and C has the highest profitability index. So B and C should be ranked first, and proposal A should be ranked at the last part, the last option. So in ranking for statistic purposes, we use 1 and 2 over 3 over 2, 1 plus 2 over 2, and that is 1.5, 1.5. And rank number 3 is letter A. Okay, actually, another consideration is that we only have 200,000, and project A has an equivalent investment requirement of 200,000 also. However, B and C has an equivalent of a total of 200,000 as well, but uh, each 100 will earn a total of 1.3%. And adding that to possible cash return would be higher than 1.22. Next is discounted payback period. This is used to compute the payback in terms of discounted cash flow received in the future. So at this point, we will be considering the time value of money. For example, a project requiring an investment of 170,000 is expected to generate an annual cash inflow of 60,000. If the cost of capital is 15%, what is the discounted payback period? So we are given the minimum rate of return or discounted rate of 15%. The annual cash inflow is 60,000. The initial investment is 170,000. So we are looking for the period to recover the 170,000 but using a discounted rate. So looking at the table for ordinary annuity, since you will be receiving an annual cash inflow of 60,000, the present value factor at 15% of ordinary annuity, uh, you may check that also, or you can use the present value of 1 for 15% for each year. You will arrive at the same amount. So since we wanted to know how many years uh, that we need to operate for us to recover our initial investment of 170,000, uh, we tried to compute it annually if we can recover the initial investment at the end of each year. So after first year, we still have to recover 118,000 because the present value of the 60,000 today after a year is only 52,000. After 2 years, we still have to recover 73,000 because the present value of the 60,000 after 2 years is only 45,000. Add it to the 52,000 previous cash inflow at present value, that does not covers yet the entire net investment. So we are still lacking for uh, 73,000. On the third year, the present value of 60,000 is 39,000, so we still lack 34,000. On the fourth year, we can now recover the 34,000, so you simply deduct it from the balance, and therefore the total payback period using the discounted rate is 4 years. In cases there is still an excess, you simply get the ratio of the balance, the present value of the annual cash inflow from the balance, and you simply add it to the uh, already covered years, and that is 3 years. Okay, we already covered all the uh, techniques used in evaluating capital investment, considering the time value of money and those techniques that do not consider time value of money. We will now go to the techniques used for preference decision, and that is when we are given options to choose one capital investment over the other, or in short, we will be forced to drop one alternative. We actually can use what we have used, or what we have learned in the previous discussion, the internal rate of return and the profitability index. These are uh, some of the tools that can be used in preference decision. But actually, even if you use the payback period, that would be uh, useful also. So you will be choosing the faster or the fastest project that could be recovered, the one with the shortest time period to be recovered. However, as presented in our reference, internal rate of return and the profitability index is the best measure for preference decision because the internal rate of return gives us uh, an easiest way of comparing to our desired minimum rate of return. So if the computed internal rate of return is less to our or less than to our minimum rate of return, so we simply uh, reject the project, or we simply put it at the last rank or the last option if we have other alternatives. So the one with the closest to our minimum rate of return, or the one with a higher value than the minimum rate of return, should be ranked first over the other. As well as in computing for the profitability index. The higher the profitability index, the more desirable the project. And we can use that for ranking purposes. Okay, so comparing profitability index and internal rate of return, profitability index is conceptually superior to the internal rate of return if they are both to be used under preference decision. The reason is that profitability index will always give a correct indication as to the relative desirability of alternatives, even if the alternatives have different lives and different patterns of earnings. Simply because another reason is that internal rate of return might give you a wrong impression that you might be able to compute for a higher value of internal rate of return. However, the project time period or lifespan of the project is shorter over the other, uh, despite having a lower internal rate of return. So the best or the superior uh, techniques or tools to be used is the profitability index rather than the internal rate of return. Next is if we will be comparing projects of unequal lives, uh, since internal rate of return might cause uh, an erroneous decision, we are uh, given a way to solve it by using replacement chain or common life approach in the equivalent annual annuity method or EAA. Common life approach compares projects of unequal lives, which assume that each project can be repeated as many times as necessary to reach a common lifespan. The NPV over this life are then compared and the project with the higher common life NPV is chosen. For the equivalent annuity, which calculates the annual payment of a project, would provide if it were an annuity. Generally, when comparing projects of unequal lives, the one with the higher equivalent EAA should be chosen. So, to better uh, appreciate the concept of common life approach and EAA, let's apply it to a problem. Say, for example, you have two options, Project N and Project M, and each investment has a different life, different lifespan. For Project N, it will run for 5 years. However, Project M will only run for 3 years. The initial investment for Project N is 400,000. For Project M is 200,000. The annual cash inflow for Project N is 80, 140, 130, 120, 110, and 100. For Project M, also uneven, 70, 130, and 120. Computing for their respective NPV at 12%, will arrive at a positive 64,910. While for Project M, 51,550. So using NPV only at 12%, it seems like Project M is more attractive over Project M because it has a higher NPV. However, if we compute for the internal rate of return, Project N has 17.5% only, and Project M has 25.2%, which is higher than Project N. So it seems like Project M is more attractive over Project N using internal rate of return. Now, if we will further analyze the two options, Project N has a higher investment requirement at the initial stage as compared to Project M, which is only half of the requirement. So it seems like if we have the capacity to invest in Project N, we can simply double uh, the Project M to get a higher rate of return. Also, we can also notice that project M could be reinvested at the end of 3 years and earn another internal rate of return uh, within the next period of 3 years, which is also equivalent to the lifespan of project N. This one is 6 years. Okay, so it seems like if we will stick to what we have computed, IRR and NPV, uh, NPV favors project N and IRR favors project M. So we have now a problem of which one to be followed. So to solve this problem, we apply the common life approach, and that is by assuming a common life span for the two projects. So we try to extend the lifespan of the project M to check whether uh, the NPV will be higher than the project N, because using internal rate of return, we already confirmed that project M is higher than project N, but using NPV, project N is higher than project M. So extending the project will arrive at an 88,200, a positive 88,240 NPV. So now, even if you use NPV or internal rate of return, it confirms that we should choose project M over project N. So we simply assume that we will be receiving the same amount of annual cash inflow for 4th to 6th year of operation. For EAA, or the equivalent annual annuity, instead of assuming the reinvested uh, project, we will simply compute for the uh, expected annual annuity using algebraic approach, and that is uh, finding the value of EAA. So we equalize the present value of project M at 3 periods, and that is 51,550, which is equals to EAA times the present value of an ordinary annuity for 3 periods at 12%, and that is 2.40183. Okay, and then we simply combine similar terms, and since we don't have any variable remaining here, we simply divide both terms by 2.40183, and we will arrive at an EAA value of 21,463. Following the same procedure for project N, we will arrive at an EAA value of 15,793. The project with the higher EAA will always have the higher MPV when extended out to any common life. So uh, when you use EAA, you don't have to assume an extended life for the project with a shorter life. Uh, upon computing your EAA, the higher the EAA will always give a higher NPV, even if you extend it uh, to equal the other alternative. And then finally, let us compute or check if there is an effect on the capital investment uh, the infusion of inflation. Okay, so let us learn this by applying it to a situation. Marv X Corporation wants to purchase a new equipment that costs 360,000. The equipment would provide annual net cash flow from operation of 200,000, and it would have a 3-year life with no salvage value. For each of the next 3 years, the company expects a 10% inflation rate in the cash flow associated with the new machine. If the company's real cost of capital is 12% or the market-based cost is 23.2%, should the equipment be purchased? Okay. So let us first try the uh, NPV using the cost of capital of 12%. Since we will be receiving an annual cash inflow for 3 years of 200,000, we simply get the present value factor of 12%, and that is 2.402, and that is 480,400. Multiply it to 200,000. So the NPV is 120,400 without the infusion of inflation rate. Now, uh, if we will be considering the inflation, we need to compute first the price index, uh, considering a 10% inflation rate. Let me just go back to the previous slide. Yes, 10% inflation rate. Okay. So we cannot use the 200,000 right away to be multiplied in the present value factor because there is an inflation rate that needs to be uh, infused or incorporated in the annual cash inflow. So how are we going to compute for the price index? Well, for year one, you simply uh, add the 10% increase. For year two, you need to square 1.10, and then for year three, you multiply it by 3. The 1.10 should be multiplied at 3, and you will arrive at 1.331. Okay, and then adjust now the cash inflow with your price index considering the inflation rate. You will arrive at a price adjusted cash inflows of 220, 242, and 266, 200. And then we cannot use anymore the 12% present value factor, but rather we need to use the market base, and that is 23.2%. If it would be difficult for you to locate a market-based percentage in the table, you can simply follow this formula, and that is 1 over 1 plus the market-based percentage or market-based rate, 1.232 equals 0.812. For year 2, 1 over square of 1.232, and that is 0.659. For year 3, 1 over 1.232 cube, then you will arrive at 0.535. Okay. Now, after multiplying the price adjusted cash flow with the present value factor of 23.2%, and summing it up, uh, you can you can see here that it is almost the same with those who uh, NPV that did not consider the uh, inflation rate, 120,400 versus 120,540. The only difference actually comes from the rounding off of the present value factor and the price index. And therefore, uh, the inflation rate is actually embedded in the present value factor already. So even if we will not be computing or embedding or infusing the inflation rate in the computation, we will still arrive at almost the same NPV. So no need to compute separately for the effect of the inflation rate because the effect of the inflation rate is already included in the present value factor. Okay, that's it. I think that's the end for the chapter 13. Thank you for listening.